Hello, and welcome to Navigating Seasonal Cycles with Jake Bernstein. The information provided in this episode is for educational purposes only. There is a risk of loss in all trading and investing. The results shown are hypothetical and should not be construed as investment advice. And now, over to you, Jake.
Greetings, everyone. Jake Bernstein, 2:22 p.m. on November the 19th. I'm located in Santa Cruz Mountains, California, and today is our podcast day for cycles and seasonals, and seasonals are cycles. We'll find out what we can do with these. Before we do anything, I'm going to give you a little commentary and a disclaimer. I want it to be more clear. Talk a little bit about my training model, some timing, precise details. We're going to talk a little bit about the date of a seasonal trade as opposed to the day of the year. I'll talk about that right now. Some people say it makes no sense to enter a seasonal trade on the 4th of July. Other people say, don't do it that way at all. Do it by calendar day of the year. In other words, is the 5th of January the 5th of January, or is it the 5th day of the new year? I find it to be confusing. People think in terms of holidays. I'm thinking of Turkey now. I'm thinking of Turkey, and I know that Turkey is going to be the third Thursday of every November. So I think in terms of actual dates, not in terms of day of year. I find it to be confusing, but do whatever works for you. I find that it works better to take in terms of the actual holiday, 4th of July, Christmas, the 25th of December, and so forth. We'll talk a little bit about what's next, but I want to talk about something very important to me. You may think, don't waste your time on this, Jake, but I'm going to do it anyway because sooner or later, we're going to have to face that issue. And that issue is right over here. I got an email from somebody who attends these sessions, and they were very specific about their likes and dislikes. I want to read you the letter. Normally, I say I don't do that. I don't want to waste time on this. And normally, I don't answer emails that come to me anonymously, especially from some websites where they're more known as being dark websites. So I'm going to talk about this anyway, even though the person didn't sign their name. I want to read this to you and express my opinion about each one of these points that the person makes, because it's important, and if it's not important to you now, it will be important to you going forward. So hello, Jake. Thank you for the weekly video about seasonal cycles. No problem. You asked for feedback. Here's mine. There is entirely too much gamification in the world of investing. So what does gamification mean? Some of you know it, some of you don't. But the bottom line is this. Social networks have taken part in this change of behavior where talking to someone on a network through chat or through someone you don't know or for some other reason has taken on this very adversarial relationship. People fight online, they get into all sorts of trouble. It's a waste of time as far as I'm concerned. And so gamification is also applied to the use of certain websites, like trading is a game. It's not an actual game, it's a game that involves money, but with the advent of sports gambling and so forth, a lot of people have gotten into the game of it. And this individual is claiming that cyclical behavior and cyclical analysis has been gamified in the world of investing. There's entirely too much gamification in the world of investing without the basement of cycles, or the debasement of cycles into nothing more than seasonal profit opportunities. What he's saying is that we're not using seasonals in a sophisticated, intelligent way. We're using it as a game. I say, and this is the reader, the writer, right, reading to you. He says, or she says, I say it's time to stop promoting seasonals as a way of trading or investing and just enjoy the beauty of the facts and the concept just like Dewey did. I need to take issue with that and do a little pushback. The bottom line is this. We're not playing a game here. We're using cycles in pragmatic fashion. As I said, the first session we did, we're using cycles to unlock their power and make lives better for people, myself and you included, which is why I'm teaching this to you right now. And the question about Dewey. If you read Dewey's work, if you're familiar with it, you know that Dewey did, in fact, propose the use of cycles in order to better mankind, humankind, when to plant crops, when to harvest crops, weather conditions, predicting weather, and so forth. And that was just the beginning of what Dewey envisioned in his original work. So this is not true. We're not just enjoying the beauty and the concepts the way Dewey did. Dewey did much more than enjoy them. Now this one really gets me. Just imagine if Oppenheimer had just kept his mouth shut, how many more lives would have been saved? Listen, I'm no Oppenheimer. I don't have some great universal secrets. So it's debatable whether if Oppenheimer had just kept his mouth shut, anything would have happened that was better or worse. The bottom line is, we can't rewrite history. It is what it is. Besides, the pre-holiday seasonals are a self-fulfilling prophecy. What the writer is saying is this: seasonals, pre-holiday, wouldn't happen if people didn't believe it would happen. He's basically saying it's a self-fulfilling prophecy, which I disagree with entirely, because remember, when Merrill did his original work in the 1950s, he happened upon it by accident. So when he went back into the late 1800s to the 50s where he was situated, the situation was very easy. The data was there. It didn't have time to become a self-fulfilling prophecy because nobody talked about it. So that logic is out the window. So while I commend you and the foundation for your work and research, you need to focus on concepts and research for the good of the research and not on how it's used. We don't need thousands of YouTubers trading this gorgeous pattern. Shame on them. And finally, you need to explain why this pattern happens. Some of us need to know why before we make trades. So I wanted to respond to this in a general way. First of all, I provide you with information and knowledge. If you enjoy just the search for the knowledge and the application of the knowledge, wonderful. If you want to do more with it, that's up to you. There's no law against it. It's legal, moral, and ethical. So if you have information and you do research, you can monetize it or you cannot monetize it. The choice is yours. Certainly, the writer doesn't have to come in to see these sessions, even though they're free of charge. If we were monetizing this by charging money for it, it would be different, maybe. But the bottom line is the research is good, it's clear, it stands to teach you things that you didn't know before, as well as a process, setup, trigger, and follow through. So if you have further comments, please write. But remember, if your email does not have a name or an email address attached to it, or if it's blocked out, I will not read it. I won't waste my time. I'm here to teach you things that can pragmatically help you, and that's what the foundation, part of the foundation, is all about. It's all about being practical and reasonable, and that's what I do here. I make no claims. I simply show you the facts as they are. You're yours to do with as you wish. Thank you very much for that, and let's go forward. And don't send me a bunch of emails because I probably won't answer them, whether you support me in this or not. We're here for a reason, and we fulfill that reason. Let's go to the next slide. So, I showed you this when we first started our sessions. The DNA of the market, very simple. Which I did a conversion. I took every year of S&P, I converted it, normalized the data, made the highest high of each year 100, made the lowest low 0, like so. And then we showed the DNA of the market. In other words, I mean taking any 1 year or 2 years or 10 years out of the picture and showing only the pure seasonal trend. I told you many weeks ago that November and December, in fact, October, November, and December were historically bullish months. And you can see how loaded it is on the right-hand side of this chart with up arrows indicating bullish weeks. So we are located right over here in Never Never Land, which I told you would be the case, because it shows basically 50-50 proposition. But then getting into the end of the month, which encompasses the pre-holiday trade on Thanksgiving, it shows 2 strong weeks with high probabilities. Let's see how that turns out. Remember, we're not trying to predict the future. We're not trying to be soothsayers here or clairvoyants. We're simply looking at history and saying the future is most likely to be similar to the past. That's all we're doing. We can then zoom in and zero in on this area over here to find more specific relationships, which I call seasonal cycles. Very simple. And think about it in these terms. If you have a cycle that's 7 years from low to low, that 7 years could be plus or minus 10 or 15%, as has been adequately demonstrated here. In fact, very professionally demonstrated with all the cycles work done by Lars and Dr. Smith. Mm-hmm. But in many cases, you can't give a specific date. When you think about a seasonal, for example, Thursday, the third Thursday of the month of November, the last Thursday of the month, I should say, of the month of November. How many days has it been since the last one? About 365. That is a very specific number. It's a very interesting cycle because it's so exact and so perfect. Not in terms of its performance, but in terms of the number of days. It's not going to happen 5 days late. Thanksgiving is only once a year, and that's all there is to it. Therefore, the cycle, in my view, is a perfect cycle in terms of the length of the trade. There's no plus or minus 10%. Think about it. So let's go to the next slide and show you a couple of things. I want to review this trade that's coming up for the pre-holiday Thanksgiving because it's clear and specific. I want to make sure there's no misunderstandings about what we're doing here. Let's do a little comparison. The top chart on the screen is this one here. The bottom is what actually happened. So this is what was expected as the market DNA. This is what is happening right now. And none of this was taken into consideration when we're doing this. So notice the twists and the turns of the market. It's up here. It's up here. It's ideally lower here. It's ideally lower here. Then it heads back up again, heads back up again, and then we're in for a strong finish if the seasonal is correct. Remember, I'm not looking at any fundamentals. I don't consider the war in Ukraine. I don't consider the war in the Middle East. Not that I don't care about that. I certainly do. But in terms of our market worth, it's specific to the pattern, and we don't look at the news or relate the news to this in any way, shape, or form. At least I don't. So let's go to the next slide. By the way, if anyone has questions about this, you can either write the foundation or write me. And these are some of the other cycles, but let's go to this. Remember, there are 3 conditions for my seasonal trading. Number 1 is a setup. The seasonal cycle constitutes a setup. It's a pattern. The pattern needs a trigger. The trigger is very specific. It's 2 moving averages, the 8 open versus the 8 close. Really simple. I'll show that in greater detail in sessions to come. But right now, we're going to go to the next step. The next step is right over here. Trigger. I have found that seasonal trades that have a probability of 80% or higher do not need a trigger. But if you're more comfortable with a trigger, go ahead and use one. To be specific, the trigger that I recommend is 2 moving averages. Moving average simple, 8 close versus moving average simple, 8 open. Logically, it's very simple to understand. When the 8 close moving average is above the 8 open, it means the market is usually opening lower, I should say, closing higher than it did the previous session. That relationship is underlying the characteristics of a bull market and vice versa in a bear market. So the trigger helps us indicate that the trade is most likely to happen because the market is moving in the right direction at the right time. Then comes follow through, which is very specific to the entry method. So you're getting follow through in either 3 ways: first target, second target, stop loss, and then 4th way, profit maximizing strategy. That profit maximizing strategy is available to be used in any of the seasonal trades and any of the cyclical trades, but it requires some specific knowledge, which I will give you in future sessions if you want me to. Let me briefly show you something else, and then we'll go on to the seasonals. At the top of the screen is a longer-term cycle in gold. At the bottom of the screen is another indicator. It's not an indicator that most of you are familiar with. It is an indicator based on sentiment. That's right. We've taken trader sentiment and turned it into an indicator. So it relates to the theory about the responsiveness of a crowd. Typically, in a crowd, a major, strong relationship, if it's held, a belief, for example, a crowd of Trump supporters or a crowd of Kamala Harris supporters, if they hold their belief very strongly, the chances are they're wrong. So what we've shown on this screen is very low small trader sentiment, right over here, 20% bullish or lower, and very strong bullish sentiment, 80% bulls or higher. We do this in a survey that we've done in my office every day since 1987. And I want you to look at the relationship, specifically along the lows. Vertical lines, I marked the lowest low, and I related it to the price. Take a close look. Low sentiment, market goes up. 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 It's almost a one-to-one relationship, as well as a leading relationship. I'll do another series of webinars, if the foundation will let me, showing the relationship between small trader sentiment and cyclical lows and cyclical highs. Very important relationship. But let's go forward. I want to review specifically for you the seasonal trade that's coming up for Thanksgiving. Let me go to another slide quickly and go through the points I wanted to make. Pre-holiday seasonals. You will remember what I talked about. Art Merrill wrote the book, The Behavior of Prices on Wall Street, talks specifically about the relationship between pre-holiday and the Dow Jones. What he said was very simple. Like, let me skip this page right here and come back to it. Let's do it this way. Here we go. So, I have a list here of all the legal U.S. holidays for the year of 2024. To this point, which is the Thursday coming up from Thanksgiving, every one of these seasonals, to my best recollection, has been profitable. The rule is very simple. Let's talk about the trade that's coming up Thursday, November the 28th. Because the holiday is Thursday, November the 28th, we buy on the close of trading Tuesday, get out of the close of trading Wednesday. It's one overnight trade because the holiday is Thursday. So when it comes to Christmas Day, for example, December the 25th, it's a Wednesday. You buy in the close of trading Monday, get out on the close of trading Tuesday. That's all there is to it. There are protective strategies you can use to minimize the loss if it's wrong, because remember, this is not 100%. In the average, it's about 75% accuracy, which most traders who manage risk effectively can make money with. So the bottom line is, no pun intended, Thursday, the market is going to be open or maybe half a day, but your strategy is going to be to buy in at the end of day Tuesday, get out on closing trading Wednesday. It's really simple. Now, if you're concerned about risk, you should be. How to mitigate that risk? It's an option. A one-day option will keep you in the trade and maximize your risk to the cost of the option. That's all there is to it. Let's take a look and see what happened in the past. Let's go to the next slide. So, this was 2023. The vertical green line represents the holiday. So this is a Thursday in 2023. And then this was the Wednesday, and this was the Tuesday. So you bought on the close Tuesday, got out on the close Wednesday, and the instrument I'm using here is S&P. Not bad for one contract overnight. And you can see that after the trade was over, it actually kept on going. There is a way to maximize this profit, which I will show you in another session. In fact, next session we'll call it profit maximizing strategies for cyclical seasonal trades. How about the year before that? 22. Let's go to that chart. Here was the trade in 2022. Right over here is a holiday. The market was open half a day. This was the Wednesday right over here. And this was the Tuesday. Buy and close the trading Tuesday, get out and close the trading Wednesday, holiday on Thursday. Very simple. Now, you're probably looking at this chart and saying, what if we bought the open? The answer is really simple. The answer to the what if question is, you've got a computer, go back and test it. You've got AI, very easily tested with AI, but right now, this is the relationship we're working with, and it's been that way for a long time. You might look at the chart and say, but look at all of this. Did we miss all this? The answer is no. There are other methods for capturing this. We're not going to mix our trades together. We're not going to mix methods together. We're simply going to use the methods that we have according to the rules. So let's go to the next one. Let's go back to this right over here. The trade before this was a Veterans Day trade, which is this one right over here. This is Veterans Day, day before, and the day before that, right over there. And let's do this. Let's go to the next one, right over here. This was the Thanksgiving Day trade in 2022. So let me show you one more thing that you might find interesting. And that is this. I can go to the computer and I can say, search June and July to see if there's any trades that happen before the July 4th holiday. That's easy to do. You simply go and select June and July, put in our criteria saying, I don't want trades that are less than 70% effective or accurate. I want to use some sort of a stop, and I want trades that are short term, in other words, 25 calendar days or less. When I do that search, this is what I get. I get a whole list of trades that meet my criteria. The first trade with 80% accuracy was from July the 10th through July the 9th and the 15th. Obviously, this trade happened after the 4th of July trade. But you'll notice in the second position right over here, we have the 6th, the 28th of the 6th. In other words, we've got June 28th through July 22nd, which encompasses the July 4th trade with 77% accuracy. So if you're looking for other combinations, they're all right here. And you can sort according to percent win, percent loss, and so forth. Very effective strategy. Again, not perfect, but very effective. And most of all, specific. You know exactly what to do. You know when to do it. You know how to do it. You know the instruments to do it. You know the setup, trigger, and follow through. You know everything, including the first profit target. Because the first profit target is right over here, average profit. So this is the average profit in points for S&P. For stocks, we use percentage average profit as opposed to points. Let's see what else I have for you today. One moment, please. So this is the complete track record. And by the way, I showed this trade. A lot of people said, wait a minute. You're saying that this trade was profitable 13 years in a row? If that's the case, I will definitely not make it this year. I say, that's a little bit strange. Being so successful, there's more reason to take it. If you're concerned about the success of the trade, then take a smaller position. Take an option strategy, but don't ignore this very significant behavior. Remember, this was published before the fact, and it worked another year again, so it's 14 years in a row now. Let's go forward, and then we'll call this to an end. You can also examine the trade right over here. So this yellow portion of the chart refers to the time that you're in the trade. We know the time that we're in the trade, and that is from June, late June until mid-July, mid to late July. Okay, that's what else I've got for you today. Yes, this same relationship, the July 4th trade, we can take it all the way back to the 1920s. So there's statistical evidence that's very strong, because this pattern has been right almost 78% of the time for so many years that I don't consider it to be a theory, but rather a fact. And what else does Jake have for you today? The track record every year. And another way of looking at the trade, by the way, this trade can happen in the NASDAQ as well, as you can see here, where it has a higher accuracy at 81.6%. So I hope it helped you find some concepts that we can relate to. Remember, the most important thing is specificity. Don't engage in thinking about why this should or shouldn't happen. The probabilities are high, and as long as you trade with probabilities on your side and you limit your loss, you will do well. Pardon the voice. And again, if you have something to say to me, you can write it to me either at my website or at the foundation, and I will answer as promptly as I can, provided you give me the context. You're polite. You tell me what you like about the methodologies that we use for the podcast, and we'll take it from there. Thank you very much for the foundation for letting me do this, and thank you for attending.